In this video, we're going to go over 7 different stocks you're going to want to be watching this week. On this list today, we have a combination of dividend-paying stocks and growth stocks. We have a lot of variety from different sectors of the market, and right now, earnings season is underway. We have some of the largest brands in the world reporting their latest quarterly results over this trading week, and on this video today, every single company of the 7 are reporting their latest quarterly results over the next 5 trading days. So this is big news because when quarterly results come out, there may be some share price volatility, which maybe create a nice buying opportunity for one of these companies. We have some very known household brands on this list today, and we have some companies that are innovating and growing year over year. So in this video today, we're going to talk about each of the 7 companies you're going to want to keep your eye on this week. These are some strong, consistent dividend-paying companies, as well as some super fast, high growth stocks that may see a boost in investor confidence with a positive earnings report. So as you know, everyone, I am the Gen Z investor, and every single day we talk about the stock market, go over different stocks you can buy and sell within your portfolio, and as we do every single Sunday, we talk about stocks to keep your eye on for the upcoming trading week. This is an every Sunday series, and in this week's video, all 7 of these companies report their latest quarterly results and need some attention over the next few days. So please hit that like button and subscribe. I want to jump right into the first stock on the list, which is Amazon. So this e-commerce giant, ticker symbol AMZN, is one of the largest retailers in the world and makes up approximately 40 to 50% of the total e-commerce world. So they are currently being traded at over $3,270 a share, and their company is up over 84% in the past 12 months. They have a current market cap of $1.64 trillion, and Amazon's a very interesting company. This is going to be a nice quarterly report where people were still staying at home, forced in somewhat of a lockdown state because of the pandemic, and doing more time shopping online, and analysts are expecting big numbers from Amazon. If we take a look at their expectations, they're expecting to see revenue estimates of $92.4 billion in the quarter, with earnings per share of $7.29. So earnings per share up revisions, it was boosted up 31 times. And if we take a look at their latest earnings reports, they have some misses and some beats, but this Q3 2020 is expected to show a 72% year-over-year growth in earnings per share. So high expectations for the company, and I believe these latest quarterly reports are going to impress, and I believe to end out 2020 throughout the holiday season without retailers being open and there's going to be no more packed stores, I believe that Q4 2020 may be even bigger, and analysts of right now are still expecting Q4 to show a 37% year-over-year increase from last year. This company is also one of the largest retailers in the world with massive revenue numbers. Beautiful revenue growth year over year, and in the past 12 months, they've brought in $321 billion of total revenue. So massive revenue growth year over year, and this company is only expanding, diversifying their assets, and continuing to grow at a fast rate. The second stock you're going to keep an eye on is Netflix, another growth company, ticker symbol NFLX, up over 85% this year. They have a market cap of $234 billion, and similar to Amazon, with this transition to a stay-at-home economy, Netflix has actually seen a boost. They have nice jumps up in new subscribers, and their platform meant for people to stay home and use for entertainment of watching videos, movies, TV shows, is actually in a great position right now. People are continuing to stay home, and as we enter to the colder months of the year, up north where people aren't going to be going out as much, Netflix is in a position to take over some great market share from away from some competitors. And for their earnings, they're expected to see around $6.38 billion of total revenue and around $2.14 earnings per share estimate. And if we take a look, another company that is expected massive year-over-year growth. This estimate would represent a 45% year-over-year growth from Q3 2019. And they're in a nice position to continue to grow because they are dedicated to improving their services and their movies and their TV shows. They're expected to invest over $17 billion into their content in 2020. That's what's going to keep them ahead. They have a goal that they will never decrease the budget spent on content. They want to keep increasing that, investing more and more back into the platform, because if they can continue to innovate and continue to put out new shows that keep their audience entertained and wanting to come back for more, they will be able to continue to grow new subscribers each and every quarter, and of course, that leads to greater revenue and greater earnings. And you can see here the company, similar to Amazon, has seen great exponential revenue growth. 5 years, around $6.7 billion of total revenue, all the way up to over $22 billion in the past 12 months. The next stock number 3, is the first dividend-paying company on this list. And that's ticker symbol KO. Coca-Cola, currently being traded at $50 a share. They're down just over 6% in the past 12 months. And you can see here they got hit hard by the month of March, have seen a quick little recovery, and have been trading somewhat flat or a slight upward slope over the past 6 months. And on the 52-week range, trading in the middle. They have a market cap of $214 billion and have a forward PE of 27.65. So this is the dividend king Coca-Cola that has been around for an extremely long period of time and have continued to provide investors with nice, solid total returns. So they currently yield out 3.28%. Their annual payout per share is $1.64, and they have a very high 90% payout ratio right now. So they've been growing that dividend at a rate of over 5.57% average over the past 5 years, and have a dividend growth streak of over 58 years. So the company, although has a high payout ratio right now, they're doing a nice job of diversifying away from their less income producing assets and shifting more capital into their assets and their brands that have future growth potential. And they currently have a dividend safety score of 80. So the dividend is still considered safe. Although the company does have a high payout right now, they're expected to bolster up their net income, reduce that payout ratio, and of course become more stable dividend payments. Stock number 4 is Procter & Gamble. Another dividend king, the consumer brand company PG currently trades at $144 per share. They are up over 22% in the past 12 months and have a current market cap of $359 billion. They are one of the largest companies on the market, and they continue to impress. They pay out a nice dividend that has been growing for over 50 plus years. They currently yield 2.19%, are only paying out a very sustainable 58.6% of their earnings in the form of that dividend, and they have a 5-year dividend growth rate average of around 3%, so that dividend is either matching or slightly outpacing inflation each and every year, and have a 64-year consecutive dividend growth streak, which is absolutely incredible. They have a 99 dividend safety rating, and this is a brand where their earning report comes out this week as well, and I expect on these earnings, their products to continue to hold up very nicely throughout this pandemic. They sell necessities. They sell brands and products where people continue to need no matter what's going on in the economy. They sell products where, regardless if you have high discretionary income or not, these are brands when you go out to the store that you have to pick up no matter what. And I believe that's what's led to this huge dividend growth streak of over 64 years and maintaining a very safe 99 dividend safety score. The 5th stock to keep your eye on this week is the telecom company, the beast, Verizon, ticker symbol VZ, currently around $58 a share, up around $240 billion right now for their market cap. Share price is down around 3.7% over the past year. Of course, you can see the March decline, but they've seen a nice recovery and trading back to around pre-pandemic highs. But on the 52-week range, a little bit on the high side. This is a massive dividend-paying company, and the two telecom giants, Verizon and AT&T, both report earnings this week. So if we continue on with Verizon first, they are currently yielding 4.32%. They pay out around 52% of their earnings in the form of a dividend, and have a 5-year dividend growth rate of 2.5% averaged over the past 5 years. So a very low dividend growth rate that is barely matching inflation each and every year. But that dividend, although you're getting a nice high starting yield with minimal dividend growth, is considered very safe with a dividend safety score of 87. So the telecom two beasts both report earnings this week. So this will be a nice opportunity to either lock in some high yield or see which one outperforms the other. The second beast, of course, is AT&T. Their share price has been hit a bit harder, down over 27% over the past year. And from the March lows, you can see here they saw a slight recovery over the first few months, but after peaking in around June at $33 a share, they have seen consistent downward motion. And as of late, a big decline in share price. So currently being traded at around $27, they have market cap of $194 billion and have an insanely high 7.6% dividend yield. They're paying out around 65% of their earnings in the form of that dividend and have been growing that dividend at a rate of only 2% averaged over the past 5 years. So another company that is just matching inflation each and every year. And that just shows that although you're locking in such a massive yield right now, don't expect much dividend growth because of the high yield. You're getting a dividend growth rate that just kind of keeps your money at the same level with regard to inflation. And they have kind of a lower dividend safety score, coming in at safe still at a rate of 65. This is another massive yield company that reports their earnings this week. You should keep your eye on. The final stock this week we're going to take a look at is ticker symbol KMB, which is Kimberly-Clark Corporation. They're up over 13% this year, another very stable dividend-paying company that has been growing their dividend for a long period of time. They have a $52 billion market cap and have seen a nice pullback away from the 52-week high. Current dividend yield at 2.79%, a payout ratio of only 55% of their earnings, and they have a nice average dividend growth rate, just shy of 5% average growth over the past 5 years, and they've been growing their dividend for 48 consecutive years. So they are very close to becoming a dividend king, and I believe they will easily hit that standpoint. I really do believe they're going to grow that dividend for 2 consecutive years with no problem whatsoever, and I believe they will continue to grow that dividend over a longer period of time as well. You can see here that they have a very safe dividend rating, coming in at 88, a company where you really don't have to worry about the dividend getting cut anytime soon, and they have a low beta of 0.61, so there's not a lot of share price volatility with this type of company. So those were 7 different stocks who all report their latest earnings this week. Every single one of these companies are going to get their latest quarterly results over the next few trading days, and they deserve to have some attention. They deserve to be watched over the next few days because we may see a nice dip or a nice positive result that may create a buying opportunity for some future growth in dividends and capital appreciation. So thank you for tuning in, everyone. As you know, we do this series every single Sunday. I am the Gen Z Investor, and I will see you in tomorrow's video.